the criticism is rife right now. Your stock picking prowess, as I said, your research, which you are defending multiple times here. I'm wondering what you make of the criticism, whether you think it's gotten too personal, the fact that there is literally now an ETF betting against you. What do you make of that?
Well, I find that very interesting, especially the last. When you think about it, it's simply a call. Well, they're shorting innovation, and that seems to me over time that's not going to be a business. If you ask me, consider the source. But they're also not doing any research. They're simply shorting innovation. If they were doing research and could point us to reasons why what we have included in our portfolio is not going to participate in the new world order, then we might have a conversation about it. But the idea of shorting innovation in America is ridiculous, I think. But here's what I do know. When I see, and this is investor psychology, when I see people so sure that we are wrong, and that they are willing to set up companies simply to short innovation and to set up funds to short innovation. You know that investor psychology, the pendulum, has swung so far in one direction that if we're right, then the rewards are going to be enormous.
I don't know how else to say it. They're not shorting innovation, they're shorting you.
I agree with you about the pendulum having swung very far. I don't know if it's all the way yet. It's hard to without the benefit of hindsight. But every time I want to pull the trigger and buy your flagship fund, ARKK, two things stop me. And maybe you can talk me and other people who are watching out of these two problems that I have. The first is not in your control, and that is the inflationary environment and what's going on with rates. If this is your strategy and you're going to stick to it, unfortunately, you're up against a headwind that is not of your making, and really there's not much that you can do about until it abates, which is that historically, go back to the last 100 years, break it down in decades with high inflation were very bad for growth stocks relative to value stocks. Just look at the 2 decades with the highest inflation, the 1940s coming out of the war and the 1970s. In those 2 periods, using FAMA French indexes, value outperformed growth on an average annualized basis by more than 10%. That is an insurmountable hurdle to anybody concentrating in growth stocks if, in fact, high inflation is going to persist. Again, that's not your problem, but I'd love to hear your take on that. The second thing is a little bit more idiosyncratic to ARK and the way that you guys do portfolio construction, which is that there tend to be a lot of glamour stocks in your index and in your products that maybe aren't that innovative. And a couple of examples that come to mind, I was kicking the tires on your genomics fund. I can't get past the fact that Teladoc is the largest holding. In what way, shape, or form is Teladoc at all involved in genomics? DraftKings, Robinhood, these are not really innovative companies. One is a bookie, and one is a fairly traditional broker that made its way by breaking a lot of brokerage rules. I don't see innovation there when I see those names, and that's why I'm not an investor as badly as I want to be. Can you talk me out of those concerns that I have? Because I think they're shared by a lot of the people watching today.
Sure. Absolutely. And Josh, I heard that you had some kind words to say about us as a firm or generally, so I thank you for those a few weeks ago.
I think very highly of you.
Thank you, Josh. So on the first, inflation. Okay, my background is economics, both economics and finance, and I do have a point of view here. The supply chain issues have lasted so much longer than we anticipated that they would take a while to work out, but not 2 years. So the question is this supply chain related, and will these inflation metrics unwind? I think a lot of what's going on is supply chain related. I know it's become unfashionable to use the word transitory, and so we won't, because it's lasted longer than we expected. However, I do think there's going to the deflationary forces that are building up in the economy today are pretty strong. Two are secular, one is cyclical. And the bond market is sort of getting this. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go 50 basis points in March, which they might, I think that it would be one and done then, we'll end up with an inverted yield curve. And then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out, something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense, while inventory to sales ratios might be low, as the consumer switches off here, and if you look at the last 3 months of either retail sales or consumption, the consumer has gone pretty flat. Meanwhile, you've got the double ordering and triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here, and it's going to hit within the next 6 months in terms of that recognition. That's the cyclical side of inflation. The secular side has to do with innovation. Our focus is understanding cost declines associated with technology and when costs are going to drop low enough so that demand in different sectors will pick up. Just give you a few examples. So for every cumulative doubling in the number of whole human genome sequenced in the world today, costs drop. The cost of sequencing drops 40% if you're Illumina, 28% if you're a PacBio on the long read side. Robotics, for every cumulative doubling in industrial robots, cost decline 50%. We have major labor shortages. So that cost decline will cause increased adoption and will lower the risk associated with wage inflation continuing. And then artificial intelligence costs, I gave that one, down 60% per year if you include both hardware and software. These are major deflationary undercurrents. The other side of disruptive innovation is creative destruction. And what does that mean? It means the existing world order, the traditional world order, is going to face disintermediation and perhaps destruction. And we certainly see this in everything, transportation, in retail. There's still a lot of creative destruction taking place, right? In the healthcare space, right? So what's going to happen is these companies whose products are either going obsolete or who have not invested enough to update them, they are going to have to cut prices. So we see major deflationary forces, and I think the bond market is on to this. If I didn't see some signal supporting what we're saying in the marketplace, like that yield curve, I'd probably say, gosh, I don't know how long this is going to last. But I have a feeling these deflationary forces have entered the bond market cycle.
Here's a look at ARK, down 58%, we'll call it, off the year high. She was with us yesterday. She defended her stock picking prowess. She defended her research. She was defiant in terms of saying, yes, these stocks were in a bubble. And she claimed many are in deep value territory. Steph, she said, we right now have, quote, one of the most misallocations of capital in the history of mankind. Conversations about valuation don't seem to really matter with Cathie Wood. She maintains this 5-year time horizon. So checking her on a lot of stuff like that remains difficult, right? Because it can always be the fallback. Well, our time horizon's 5 years, so who cares what the stock does now? If you buy these stocks today, you're going to be supremely happy in 5 years because you've made a tremendous bet on innovation, and anything but that or seeing it that way, you're simply missing the boat. I'd love to get your take on the points that she makes here about a lot of these stocks, which many of our viewers have owned and unfortunately have ridden down so far.
Yeah, I mean, anything can happen in 5 years' time. That's impossible to gauge, right? So momentum is really good on the way up. but on the way down, you're catching a falling knife. There's no valuation support. And so when you're looking at price to sales, total addressable market, which I have also done in terms of trying to see big picture and where their market share of certain companies can go, but the market doesn't want that right now. They don't want the non-earners right now. There's no way to value these companies other than to think about out in 5 years what the markets are going to look like. And again, especially in technology, things can change on a dime. I mean, look, you go back to Amazon. It's actually trading at 45 times earnings. I think that's one of the cheapest it's been in a very long time. And that can't get out of its own way because the investors in the market right now, they're not rewarding high multiple stocks. Maybe they will, especially if the economic growth slows. Maybe we get back into growth. But right now, I think these stocks, there's no way of knowing how much they're going to go down. And I hate to pile on because I do think she's very bright and I do believe in a lot of the things that she says. However, I don't even have a 5-year time horizon. I don't think that's a prudent way of investing, quite frankly.
I mean, if you just look at some of the stocks, right? Not everything is going to get a 5-year time horizon. There's just not enough patience to go around to sit on big losses and stay with the program. Josh, I got Palantir, sold about 5 million shares of Palantir. That's after loading up on it in recent months, and that's with an earnings report and a stock that's gotten absolutely obliterated. There it is, 63% off of its high. That's on Roku, which is in the innovation fund. She defended it yesterday. That's a stock that's well off of its high. Look at that, 77.5%. That takes us to DraftKings, which is another stock that's absolutely getting hammered today. You take all three of those in context of the greater Cathie Wood story, and I'm wondering what you make of it and the conversation that we had yesterday, in which I know you heard all of it.
You know, there's a dynamic in play here that there really is no precedent for. One of the things that ARK is doing that's different from every other active manager in history that's ever gotten to 50 billion in assets is they're playing poker with their cards face up. Every night, we know what all of ARK's trades were. We know what they're adding to. We know what they're selling. That's why you guys in the media cover ARK so much. So it actually was working in their favor on the way up. They would announce that ARK just bought XYZ stock, and a whole army of retail traders would get that news from CNBC, Bloomberg, MarketWatch, Yahoo Finance, and that would almost act as amplification, driving more people to buy those stocks also. And so there was like this halo effect of ARK's latest buy is whatever. So that was great. That went really well for a long time. Raised a lot of money that way, raise your profile, etc. But unfortunately, we're seeing that same process works in the reverse. So everybody knows their holdings, and everybody knows that there are redemptions and that there's money coming out. Not every day, but everybody understands that they're not raising 10 billion a month or 10 billion a quarter the same way they were in 21. So if you know that and you're a trader, you have the ability to shoot against those holdings, and you have the ability to even press shorts on those holdings depending on your level of sophistication. So we've never seen that before.